Three drivers, one kind of car, three ways to pay: lease, loan, or cash. Ask each what it costs a month, and every confident answer is wrong. Because on average, a driver believes a car costs about half of what it truly does. They'll say $600 or $800 or nothing, it's paid off. The truth is nearly double, and it hides in plain sight. This is what a car really costs. 3 layers worn in 3 costumes, settled by one formula. For any car in any country. Here is the myth: the monthly payment is the price of the car. It is printed in the ad, it fits the budget, it feels like the whole story. In one of the world's biggest car markets, researchers asked 5,500 owners what their car truly costs each month. Almost everyone guessed low, and the pattern is telling. The one cost people got right was fuel, the only cost with a weekly receipt. The costs they missed were the quiet ones, and the quietest of all is also the biggest. It never sends you a bill, you only meet it on the day you sell. Layer 1. Depreciation. The biggest cost of a new car is not fuel, not insurance, not repairs. It is the fall in the car's own value, the largest line in every serious cost study, on both sides of the Atlantic. And it is brutally front-loaded. Up to 20% gone in the first year, a third or more by year 3. On average, around 40% in 5 years. On our $50,000 car, that is roughly $21,000. Not billed, just gone. And here is the sentence the whole comparison turns on. Somebody always pays for the fall. The only question each contract answers is who and at what price. Layer 2. The money. A $50,000 car needs $50,000, and that money always charges for the ride. Borrow it and the price is printed. In the largest car market, about 6.4% on new car loans, over 11% for used. And that rate on the money you borrow is what Layer 2 costs you. Lease, and the price hides. Where the interest rate isn't printed, it lives inside a money factor, a tiny decimal built not to look like a rate. Multiply that decimal by 2,400, and out comes the interest rate the lease was hiding. 0.0025 becomes 6%. Ask the dealer for the money factor, then do the math yourself. Pay cash and the price turns invisible, whatever that money could have earned instead. Long-run stock markets have returned about 10% a year, call it 6 to 7 after inflation, though, unlike a loan rate, nobody guarantees it. Same money. 3 costumes. Same actor. Layer 3. The running stack. Insurance. In the largest car market, full coverage, the kind that also pays for your own car, not just the other drivers, averages around $2,000 a year. And note the fine print. While a lender or a leasing company holds a stake in the car, that full coverage is required. Own it outright, and dropping to basic liability becomes your choice, roughly half the premium. Maintenance, repairs, and tires, about $0.10 a mile on a newer car. At a typical 15,000 miles a year, call it $1,600, and 3 to 4 times more once the car passes year 6. Fuel is the bill you see every week, and still only about 1/6 of the total. Registration and taxes, call it $800 a year. Stack all 3 layers together, and the honest invoice finally appears. So here is the honest invoice. In the largest car market, the most thorough running study prices a typical new car, even a bit cheaper than our $50,000 example, at about $965 a month, all in, every layer. 77 cents for every single mile. Remember the 3 drivers. About $600, almost $800 or nothing, it's paid off. That is what the payment says. The invoice says, close to $1,000 a month. So the survey was right, most drivers see about half the bill. The myth is not that people are bad at math. It is that most of the invoice is printed in invisible ink. Now lease, loan, or cash. Here is the reframe that makes the whole choice simple. All 3 pay the same invoice. The value falls either way, the money charges either way, the car burns fuel and tires either way. The paths differ in exactly one thing: how the bill is packaged and who carries which risk. Remember the sentence, somebody always pays for the fall. Leasing rents the fall. You prepay the drop the leasing company expects and hand the car back owning nothing. A loan buys the car with rented money, so you own the fall and the debt. Cash buys it with money that quietly had other plans. Same fall, same invoice, 3 costumes, and each one answers who pays and at what price. Open the lease payment, and there are two big things inside. One, the depreciation slice, the gap between the price and the residual value. The residual is the leasing company's written bet on what the car will be worth when you hand it back, typically around half the sticker after 3 years, and set a notch below what the car will likely really fetch. That cushion is the resale risk, quietly shifting onto them. 2, the rent charge, the money cost in costume. Because you only buy the slice you use. In the largest car market, the average lease runs about $140 a month below the average loan. That is the headline that fills showrooms. Here is a field check drivers use before they sign. Divide the monthly payment by the sticker price. Around 1% or less is a strong deal. But the payment was never the whole invoice. The rest of it is waiting at the end. The day you return a leased car, a clerk walks around it with a checklist, and the contract you signed 3 years ago starts talking. First, the mileage meter. Your allowance was 12 to 15,000 miles a year. Every mile past it, 10 to 25 cents, sometimes more. Drive 5,000 miles over, and that single line runs into 4 figures. Next, the damage test. Any scratch, dent, or stain bigger than a credit card is chargeable. Some houses forgive the first $500 of wear, which quietly tells you what a normal turn-in bill looks like. Then the exit fee. A disposition charge, $300 to $500, often waived only if you lease your next car from the same brand. A loyalty toll. And the entry fee you paid at signing. Usually rolled into the payments, so you paid interest on the fee. Leave early and it gets worse, up to several thousand. The lease is not a trap. It is a menu. But you order everything at signing, and the bill prints at the end. A loan hides its trap somewhere stranger, in the geometry. The loan's trap is geometry. In the early years, your payments are mostly interest, so the balance falls slowly, while the value falls fastest in exactly those years. 2 curves. And for a stretch, the loan sits above the car. You owe more than it is worth. In the largest car market, 3 in 10 trade-ins are underwater, by around $7,000 on average. Here is the spiral. Owe more than the car is worth. Roll that gap into the next loan. And on average, those buyers now finance nearly $56,000 at over $900 a month. A fifth of new car buyers now pay $1,000 or more every month. The dealer's fix is always the same: stretch the term. A longer loan shrinks the monthly payment and quietly grows the total interest by thousands. There is an old rule built to stop exactly this. 20% down, no more than 4 years, and all car costs under 10% of your income. Which leaves cash, the path that feels free. No interest, no lender, and 2 real freedoms. Nobody forces full coverage on you, and nobody meters your miles. But run the honest ledger. $50,000 parked in a driveway is $50,000 not working anywhere else. Priced at the same rate as the loan, that is roughly $7,900 of quiet cost over 3 years. Almost exactly what the borrower paid in interest. The difference, the borrower's rate was guaranteed. Your alternative return is not. And one more honest line. In the largest car market, only about 6 in 10 adults could cover even a $400 emergency in cash. So the cash versus loan call isn't really about interest at all. It's whether you can spare the $50,000 and still sleep. Cash is not free. It just hides its invoice best. So put all 3 drivers at the same table. Same $50,000 car, same 3 years. 2 things before the numbers land, these total, set aside the running costs. Near identical whichever way you pay, and each already subtracts what you get back if you sold. So each number is only what that path costs you differently. And because we price the money the same for all 3, the cash buyer's foregone return set at the loan rate, the conservative choice. The money line comes out almost identical. Rent charge, loan interest, foregone return, all within a few $100s. Same money, 3 costumes, same actor. Now the totals. Leasing, about $28,700 and nothing to sell. Financing, about $25,100, and you drive away owning the car, worth around $32,000. After the $17,000 you still owe, about $15,000 of that is real equity. Cash, about $25,400, and you own that same $32,000 car, but unlike the borrower, you owe nobody, so all of it is yours. Only the lease ends with nothing to sell. The spread is roughly $3,600, about $100 a month. Not waste a price. The lease charges it for flexibility and for taking the resale risk off your shoulders. Remember, somebody always pays for the fall. If used values crash, that risk pays you. But change one input, a promo loan, a subsidized residual, and the ranking flips. The ranking is fragile. The method is not. Here is the formula. For any car, any path, any country, the true cost equals depreciation, plus the money, plus the running costs, minus what you get back. Price all three paths with that one line, using your own numbers, and the winner falls out on its own. And you can look up the biggest input before you ever sign. Check what a 3-year-old version of the car you want still sells for. That gap is your depreciation. But before you optimize the packaging, look at the two levers that dwarf it. Lever 1, the car itself. Take the biggest market's numbers. A sports car built to last loses barely 10% in 5 years, while a fast-aging electric hatchback loses over 60%. It's the same formula, but the biggest line is 6 times larger. Lever 2, how long you keep it. Every year you hold, the fall slows and the fixed costs spread thinner, drive more miles, and the cost per mile drops by 1/3. Keep a car past about 5 years, and buying starts beating leasing almost every time. The cheapest car is rarely a clever contract. It is the car you keep. Depreciation plus the money plus the running costs minus what you get back. The same formula for a lease, a loan, or a cash deal. So before you shop contracts, shop the car and the years. That's where the money moves. Lease, loan, or cash, which should we open first? Tell us in the comments. Most requested wins.